We want to stick with how COVID-19 and coronavirus, the pandemic, is impacting investors worldwide. Seema Shah is the chief strategist and principal global investors, global investment strategist, joining us now. Seema, it's good to see you.
Nice to see you. Thanks.
I want to start with something that you pointed out, which is that a second wave of infections, at least in the summer here in the United States and Northern Hemisphere, shouldn't be too troubling as the first wave. And yet we hear from people like Dr. Fauci that we're still in the first wave. Can you help us see more of what you're telling us?
Yeah, sure. So I think what I mean by that is, in terms of the economic impact, it shouldn't be as awful as we saw in March. And the reason I say that is because we're looking more at localized shutdowns. We're not looking at nationwide lockdowns. We do think that as the virus has continued, medics have learned more and more about how to control the virus. So even if there is a big second wave in the winter this year, then hopefully it shouldn't result in a nationwide lockdown. And certainly that's what the market has been pricing in. Now, the renewed cases in the US, I would actually class that as a continuation of the first wave, as a result of maybe premature opening. So you could see, as we just heard, that this is going to change a little bit of the policies the government has been bringing in about reopening.
Hi, Seema, it's Julie here. Just as you're talking about, we might see regional sort of effect from coronavirus. Are we going to see also a return of more sector differentiation, right? Because we were seeing that when the pandemic really started ramping up. And then we saw a big recovery, and particularly the beaten up names. But with this renewed case rise, and also with the EU considering this travel ban on travelers from the US, could we see that comeback of sector differentiation?
Yeah, I think so. I think it's been a timely reminder that there is still that trade-off between economic activity and the virus. So in those sectors, such as the entertainment, leisure, airlines, these are still going to be concerns for us. It's one of the reasons why we've maintained our preference for more of the defensive sectors, such as technology, which are less affected and actually in some ways benefit from the kind of shutdowns that we've been seeing. So absolutely, I think that's the case. And I think with, there's also regional, from a global perspective about how this may play out. And you can see more and more people talking about the potential for a European catch-up, partly because it seems like the cases have been managed a little bit better in Europe, partly because it's just taken a little bit longer to open. They've waited for the curve to really flatten before they've opened up.
Seema, I'm wondering, as you look at the developments around the virus, what type of data really poses the biggest risk to markets, right? I mean, is it in cases, increases in certain regions, increases in deaths or hospitalizations, or is it really just when policymakers actually impose broader restrictions or roll back some of their plans to reopen because of the resurgences?
Yeah, that's a really good question, and it's something that we've been talking more and more about in the last week or so. So originally, I think that what people were closely following was death rates. That gives you the clearest indication of where the virus is going. Now, what we're seeing with the US is actually hospitalizations and death rates haven't increased that much. It's really about the case of cases increasing. So that brings you to looking closer at what are the governments, how are they going to be responding with regards to nationwide lockdowns. But the other thing that we have been thinking about more and more is, as we're learning more about the virus, you're finding out that actually a lot of people who suffered the virus and then recovered are being left with longer-term health illnesses. So we think that actually maybe you could see in a couple of months' time market attention returning more to the number of cases rather than death rates. So look, it's still an evolving issue. We have a huge amount of uncertainty, and I think that what we have just been reminded of, at least in the last week or so, is that it's how this virus evolves, how much is it being contained. That's still going to be the main driver for markets for the foreseeable future.
Jared Blickery here. You just brought up a great point in that, and I would just want to kind of build on it. We threw preventative care out the window for a few months here, and not only people whose health are affected negatively by COVID, but just by the lack of preventative care over a period of time. And then you have people who are afraid to go to the ER for stroke and heart attacks. What are some of those lasting impacts and any specific sectors in the market that might affect?
I think it's difficult at this stage because I think what we're learning, and of course I'm definitely not a medical expert by any means, but I think that what we're learning is the kind of, it's so widespread, the lingering effects of this virus. But what it does mean is that as we learn more and more about this, the people who've been considering themselves quite healthy and therefore are not as worried about catching the virus are maybe going to have second thoughts about that. And then the implications of that is it can continue to weigh more on household behavior. So, what is that return to normal? When are people going to feel comfortable about going about around the normal business that they had before? So as we start to hear more about health effects that are long lasting, you could see some more caution actually creeping back in. And that's going to have a significant impact on markets potentially.
Seema, let me ask you about that normal behavior, because if you push COVID to the side, we've got huge debt overhangs at the government levels globally. We have deglobalization underway, and you have, those of us who are just basic consumers might be afraid of tapping our savings. What does that mean going forward?
I think as we look beyond the kind of next year or so, I think the debt issue is going to be the most important one that we're going to be facing, because somehow governments are going to need to pay this back. And either it's, typically it's either through taxation or you try and grow your way out of it. Now, growing your way out of it at the, unless there's a vaccine, it's going to be quite tough because households are simply not going to be back to normal. So this brings you into slightly murky territory with regards to inflation, what central banks do. It's going to be difficult. I think the problems are going to be more in the emerging economies rather than developed economies, but it's something that we're going to have watch very closely. And as regards to the supply chains, we are hearing more and more about companies deciding that it makes more sense to try and think more about onshoring. So there could be some ramifications for emerging economies, especially from an investment perspective.
Seema Shah is Principal Global Investors, Global Investment Strategist, and we appreciate your insight here on The Move.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.